Yeah, so we're looking at overbought, oversold measures, primarily things like the stochastics and the DeMark indicators, of which the DeMark indicators are flashing one of their first oversold counter trend signals in some time for crude oil prices. That's just on the daily chart. So it's only a short-term indication, but in this tape, we'll take what we can get. Obviously, the momentum has been really strong to the downside behind energy of late, and it's been very strong to the upside behind yields and the dollar. And these macro moves really have just been relentless. So far, we've not seen the reactions that we would normally see to these kinds of signs of downside exhaustion or upside exhaustion, for that matter. So we can't have a lot of conviction in the signals, not until we actually see momentum shift to some degree. We would expect that to happen from a top-down perspective this week, but just briefly, something similar perhaps to what we saw in late May.
So from the top down, suggesting what? That you're going to have to see sort of the dollar to maybe show some signs of reversing, or how would the sequence play out?
Yeah, it's hard to know exactly what would be the driver. My thought is perhaps the market's really focused right now on two-year yields, for one. Yeah. But we are looking for an oversold bounce. Again, somewhat non-committal to that. We're not recommending adding exposure in anticipation of it. But we do have some extremes also in our market internal measures. So we're looking for an oversold bounce in the equity market. And that would be something that would naturally be associated by a little bit of a relief from the momentum behind some of these moves, including the energy move. What we saw on Friday were a lot of gaps down in energy stocks and the complex more broadly as well. And sometimes those gaps down also tend to be exhaustive. So we're looking at benchmarks like the energy sector spider or XLE, and that came right below its 200-day moving average. Now, that's not necessarily a positive thing, but if you always think about the 200-day moving average as a cushion, not a precise point. And if you look back over history, it's actually pretty normal for XLE and a lot of other ETFs that represent sectors to find support very close to but slightly below their 200-day moving averages. So there are some support levels somewhat nearby still.
And you mentioned that just in general with the equity market, you would expect some kind of a bounce here or relatively soon, but with low conviction, because we did, break through the closing low. It seems as if it hasn't responded yet in an aggressive way to the oversold backdrop. What would you be looking for in any bounce to try and interpret whether it's going to be meaningful or not?
Yeah, and I would suspect, just based on the comparisons that we're making, that it isn't going to be meaningful, not yet at least. We don't have that kind of volatility washout that we're looking for before we get the next major relief rally. We do think we'll get another one later this year, but we don't think this is likely the start of it. We're looking at those market internals, things like the AAII data that you highlighted last week. These internals don't often get this oversold, so it has us paying attention. And what we would look for is maybe several days of upside on the back of these signals, just using that sort of March or late May analog. And for the S&P 500, the initial resistance is roughly between about 39.45 and 39.80. Seems too aggressive to me, to be honest, as a targeted level for an oversold bounce, but it is the initial resistance, and therein we could get a pretty decent bounce out of the market here. We would say that it's not a buying opportunity, but perhaps will provide a better selling opportunity, where we would be essentially sort of managing risk yet again, would be on a breach of the summertime lows. And that's, of course, roughly 36.36. That's a very psychologically significant level. We've already taken out the support level that I've been highlighting for some time, around 38.15. And that breakdown has a very high likelihood of being confirmed on this Friday.
And in terms of, you mentioned the two-year note yield, which really seems to be kind of setting the pace for other markets. Any signs there that that one is running its course, at least in the short term?
Yeah, it's interesting. From those same DeMark indicators on the daily chart, so short-term counter-trend signals are pretty widespread in the Treasury market. They're widespread in the equity market. Even from a bottom-up perspective, we see a lot of individual stocks just over the last 2 days. So it's a pretty new development that have these signals. And when you see a collection of them like this, both on the macro front and also bottom up, they tend to be a bit higher conviction. Where these signals are confirmed oftentimes, and it's not exact for every individual security, but is when you see a close that's above the close from a few days days ago. And that just essentially shows a shift in intraday momentum. And that's what we would be looking for, to have more confidence that this is an oversold bounce that we can at least leverage to sell stocks at a better price.
Got it, Katie. Great to catch up with you. Thank you.